Banking, borrowing money. A language presentation from Lanternfish ESL. Borrowing money. People can borrow money from a bank. This means the bank lends people money. We also say you take out a loan from the bank. In other words, the bank gives you a loan. Some people take out loans to buy a car. Some people take out loans to buy a house. When you borrow money, you are in debt. In other words, you owe money. When you take out a loan, you have to pay it back. Credit ratings. Before a bank will give you a loan, they will do a credit check. When banks do a credit check, they see how much money you owe and whether you paid back loans in the past. If you don't owe money and have always paid back loans in the past, you will have a high credit rating or a high credit score. If you owe a lot of money and haven't paid back loans in the past, you will have a low credit rating. Guaranteeing a loan. Banks need to make sure people pay back their loans. There are two things that banks can do to make sure they get their money back. Banks may ask for collateral. Collateral is something of value you promise to give the bank if you can't pay your loan back. Banks may also ask for somebody to co-sign the loan. If somebody co-signs your loan, they promise to pay it back if you don't. A mortgage. A mortgage is a special loan people take out to buy a house. A mortgage is usually a long-term loan, often 20 or 25 years. When you take out a mortgage, you usually have to make a down payment. A down payment is an initial payment you make when you take out a loan to buy something. Interest. When you take out a loan, you have to pay interest on that loan. The interest is the cost of borrowing money. The interest rate is how much interest you will pay. The interest rate on some loans is fixed. That means you pay the same interest rate every month. The interest rate on some loans is variable. That means the interest rate changes from month to month. Variable interest rates are usually cheaper, but riskier, because the interest rate might go up. If the interest rate goes up, you will have to pay more money. That is bad for you. If the interest rate goes down, you will have to pay less money. That is good for you. Credit cards. You can also borrow money on a credit card. But be careful. Credit card interest rates are very high. If you do use your credit card, it is important to pay it off right away. If you pay it off before the end of the month, usually there is no interest. The money you owe on your credit card is your balance. Making payments. Usually when you take out a loan or a mortgage, you have to make payments. On some loans, you make monthly payments. That means you make a payment once every month. On other loans, you make bi-weekly payments. That means you make a payment once every 2 weeks. Your payment includes interest plus principal. Principal is the original money that you borrowed. If a payment is due by a certain date, that means you have to make the payment by that date. If a payment is overdue, that means you are late making the payment. Sometimes there are fines or penalties when you make late payments. That's why you should always make your payments on time. If you pay off all of your debts, we say you are debt-free. Defaulting on a loan. If you can't make your payments, you might default on your loan. That means you don't pay it back. If you default on a loan, the lender may want to take your collateral. If somebody co-signed your loan, they may ask the co-signer to pay instead of you. If you default on a car loan, the bank will repossess your car. If the bank repossesses something, that means they take it away. If you default on a mortgage, the bank will repossess your house. If you default on a loan, you will get a poor credit rating or a poor credit score. If you default on a loan, it will be harder to borrow money in the future.